First thing I want you to do is reduce your automatic costs, and this is something that most people overlook. Because when you make $1,000, all $1,000 don't go into your bank account. What happens is first, the government's going to want to take their share with taxes, and then if you have something like a 401k, some of this money is going to go in there. But this is where I want you to look into both of these things, your taxes, things like your 401k, and see if you can reduce your costs, because what happens is some of this money goes to taxes, some of this money goes to 401k, and then whatever's left goes to you. And I drew you right here. For my male followers, I drew you a mustache, or as we like to call it in my native language Punjabi, a much. And for my female followers, a braid, which in Punjabi we call a gut. So now, what you got to understand here is your taxes on 401k money is automatically being taken out. But the question is, are you getting the most value, and can you keep more of this money for yourself while still getting the same returns? Because most people in America are overpaying on their taxes. And most people in America don't know how much their 401k fees are. How do I know? Well, NerdWallet did a study and they found that 92% of Americans have no clue what their 401k fees are. Now, if you're listening to this video and you're saying, wait, Jaspreet, do all 401ks charge fees? Because I didn't know that I had a fee to pay with my 401k. I hate to be the person that breaks the bad news to you, but yes, every single person who has a 401k, who has money invested in these funds, has fees. So let's go through how to do this, starting with taxes. As an attorney, who's not your attorney, what I can tell you is that our tax code is a rule book, period. And the person that gets the least flexibility is somebody who earns their money through a W-2 income from their job. When you earn money through your investments, when you earn money from your business, you have a little bit more flexibility. Now, that doesn't mean that you have no flexibility when you earn money from an income through your job. But this means now you're going to have to be strategic. Now, of course, I want you to invest your money. Now, of course, if you start a business, that's great. I'm not against these things. But even if you are just a W-2 income, I want you to see and invest some time and maybe a little bit of money to make sure you're not overpaying in taxes. And as you make more money, as you get into the six figures of incomes, now it becomes even more worthwhile for you to maybe spend a couple $100s to hire an accountant to review your tax return to make sure you're not overpaying in taxes. So what are some ways that you can do this? Number one is making sure that you're maxing out your deductions. And number two is potentially starting a side hustle. Because if you start a side hobby, well, now the expenses you use for your side hobby can be a deduction. And if you lose money, this can be used to offset some of your ordinary income from your job. So, for example, let's assume that you like cooking and you want to start an Instagram page or a blog on cooking. And at the same time, you want to do a kitchen remodel. That way, well, you have a nicer kitchen. That way you can also cook some nicer things and talk about it on your blog. So now if you spend $20,000 remodeling your kitchen, this can be a business expense on your business. And if your business doesn't produce at least $20,000 worth of income, that would be a loss for your business. And some of this money could be transferred over to reduce your taxable income from your job. Now, again, I am not a licensed tax advisor, but this is where, when you start getting into these things, it helps tremendously to have a good tax advisor. And for the sake of this video, I'm not going to go too deep into this, but I already made a video where I talked to my accountant on different ways and things that you can do as an employee to reduce your taxable income. And I'll link that video for you down in the description. The second thing I want to talk about is your 401k. Because your 401k, when you invest money into 401k, whether it's a Roth or a traditional, you're putting your money into these funds, which are going to invest your money for you, which is great. But now what you got to understand is these funds that you're putting your money in, are they low cost or high cost? Because what a lot of people would consider low cost might end up actually being high cost. So your homework here is to look up your 401k portfolio and take a look at what your expense ratio is, like you see on the screen. Now you might say, well, Jaspreet, a 0.85% expense ratio doesn't sound like that much. Like if I invest $100, that's less than a $1 fee. Is that really a lot of money? Well, the question is now, if you project that 0.85% expense ratio over the course of 40 years, how much is that going to cost you? And if you invest $1,000 a month for the next 40 years and you can get an average, say 10% return, that 0.85% fee is going to end up costing you more than $1 million out of your investment portfolio. It's going to cost you somewhere between 20 to 25% of your investment portfolio because you're paying less than a 1% fee. This is why it's so important for you to check your fees, because guess what? There are other funds out there that could cost you less than 0.1%, which means you could get similar returns and keep more money in your pocket. Now, the reason why some people like these higher fee funds is because these funds will try to promise higher returns than the lower fee funds. Now, of course, it's not guaranteed, but this is where what you have to understand is, are the higher fees justified through the higher potential returns? And this is where some people like Warren Buffett says, I don't think so. What Warren Buffett says is that you'd be better off with one of the lower cost funds because it's going to keep more money in your pocket. And Warren Buffett even did a $1 million bet. Where what he said is if you just put your money into a low cost fund and left it there for 10 years, that you would outperform one of these higher cost funds managed by the money managers. And after 10 years, he was right and he won $1 million. So I want you to take a look at your 401k today, see what your fees are, and see if it might be worthwhile to find a fund that could potentially cost you less money in fees so you can keep more money in your pocket, because those little switches could potentially save you hundreds of thousands, if not even millions of dollars, just by making a teeny tiny little switch. Now, moving on to number 2, once the money hits your bank account, after you pay taxes, after you pay for your 401k, the second thing I want you to think about now is, once this money hits your bank account, what do you do with it? And what most people assume, if you want to build wealth, is I gotta go and invest my money. I gotta go and start buying assets. But hold your horses, because what you got to do is make sure you have laid your foundation. Because it's always one of the most difficult things for me to hear when somebody's talking about, I have $8,000 worth of credit card debt, I have no savings, I want to go and invest in stocks so I can get rich. We got to flip the priorities, and what you got to do is you got to lay your foundation first. And what I mean by laying your foundation is you got to do 2 things. Number 1, if you don't have any savings, the first thing you got to do is you got to save $2,000 in a separate bank account. This is your start to your emergency fund. This is your start to your savings that's going to protect you against emergencies. This is not money you're going to invest. This is not money you can use to buy a watch. This is not money you're going to use for a down payment on a car. This is money you're going to keep there just to protect you against you lose your job. This is there to protect you against something bad happening. So you got to take $2,000, put it here as fast as possible. Once you do that, the second thing I need you to do is you got to work to pay off your credit card debt as fast as possible. Because if you have credit card debt and you're paying 15, 25% a year in interest, it doesn't make sense for you to take this money and go and invest it in the stock market, because guess what? The stock market averages a 10% return. That's what it's had averaged for the last century. So if you're paying 15 to 25% on your credit card debt, why would you want to try to get a 10% return when you could get a guaranteed 15 to 25% return here? This is now part number 2, where you got to lay a foundation, save this $2,000, pay down this credit card debt, which then brings us to number 3. This is where you got to build a financial system. So now what we have is no credit card debt. You have $2,000 saved up in a separate bank account for emergencies. You have this check-ins account where your money goes to. Now you're going to open a third bank account. This is money that you're going to hold for your investments. So what you're going to do is you're going to have a separate bank account here. I'm going to call this I. This is going to be your investment bank account. Not your actual investments here, but the money that you're going to invest. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.